The storm is closing in on America. The economy is cracking under pressure, and experts are warning that a recession is already building momentum. When it hits, not every state will survive it the same way. Some are hanging by a thread, weighed down by debt, weak industries, or shrinking populations. And there are 12 states most at risk and could be the first to crumble when the U.S. economy finally crashes. Number 12, Indiana. We open in the Midwest. Indiana has long been called the crossroads state, a place where highways, railways, and factories connect the country. But those crossroads now lead straight into trouble. By fiscal 2025, Indiana's emergency funds had dropped sharply. The state once had a comfortable financial cushion, but now its reserves cover less than the national median of 46.9 days of spending, according to the Pew Charitable Trust. That might not sound dramatic, but in a recession, it's the difference between keeping schools and hospitals running or shutting them down early. Indiana's economy depends heavily on manufacturing, especially auto parts, steel, and engines, built around cities like Gary, Fort Wayne, and Anderson. When national car sales fall, Indiana feels it instantly. Since early 2024, production orders have slowed, and factories are cutting hours or freezing new hires. These aren't abstract problems. Families who've worked in the same plants for generations are now struggling to pay rising bills. Adding to that, thousands of younger workers have been leaving the state for better-paying tech or logistics jobs in nearby Illinois or Tennessee. This brain drain leaves smaller towns emptier and older, with fewer taxpayers and less consumer spending. Local governments collect less revenue, meaning road repairs get delayed, public services are cut, and community budgets shrink. It's a quiet downward spiral that builds momentum each month. As Indiana weakens, the warning spreads across the Midwest. It's the same pattern seen before the 2008 crash. Jobs fade first, then housing prices dip, then tax bases crumble. If Indiana slips further, it could drag nearby states into the same pit. Number 11, Ohio. Just east of Indiana lies Ohio, a state that reflects the national economy like a mirror. When America grows, Ohio thrives. When America slows down, Ohio bleeds first. That's happening again. Since 2023, Ohio's factories have been fighting to stay busy. Manufacturing output, especially in metals, auto parts, and machinery, has barely moved. Exports of fabricated metals dropped nearly 9% by mid-2025, a blow to regions like Toledo and Cleveland, where these industries anchor entire communities. Every closed factory line means lost jobs, empty storefronts, and declining property taxes. By late 2025, Ohio's rainy day fund could only cover about 30 days of state spending, down from 45 days just a few years earlier. That's not nearly enough cushion for a state so reliant on industry, and trade cities like Youngstown, Dayton, and Akron are already seeing cracks appear: falling home prices, rising credit card debt, and more foreclosures. In Youngstown alone, the average home value dropped about 6% since early 2024, while consumer debt climbed sharply due to inflation and job insecurity. The problem here isn't just money, it's morale. Many Ohio towns have never fully recovered from past recessions. The collapse of steel in the 1980s and the 2008 financial crash left deep scars. When another downturn hits, it doesn't just reopen old wounds, it makes recovery harder each time. Ohio's pain will be the Midwest's warning siren. Once it begins to crumble, businesses and investors start pulling out of the region altogether. And when that happens, we shift from factories and steel to a state that depends on something entirely different. Number 10, Nevada. Nevada is built on risk. It thrives when people are spending freely, flying in, gambling, eating out, booking hotels. But that kind of economy crashes hard when people start saving instead of spending. In early 2025, Nevada began to feel the pinch. Gaming revenues in Las Vegas dropped about 3% compared with the same time in 2024. It might sound small, but for a state where the casino industry brings in billions, it's a serious warning. When tourists stay home, hotel rooms sit empty, restaurant workers lose shifts, taxi drivers wait longer for fares, and tax money dries up. Nevada depends heavily on sales and gaming taxes. When those disappear, the state's entire budget takes a hit. This isn't new. During the 2008 financial crisis, Nevada's housing market completely collapsed. The state faced a $1.2 billion shortfall in a $6.8 billion budget, one of the worst in the nation at that time. Even now, Nevada hasn't fully rebuilt its safety net. The population has grown, but most of that growth is in service sector jobs that don't pay enough to save. If tourism dips again, it won't just hurt the casinos, it will hit the families behind them. Workers in places like Reno, Henderson, and North Las Vegas live paycheck to paycheck. When hours are cut or tips vanish, it immediately affects rent payments and local businesses. Nevada's lack of income tax has always been a selling point, but it also means the state depends almost entirely on tourism revenue to fund schools, hospitals, and infrastructure. When tourists stop coming, those systems start to crack. So, while Nevada's lights may still be bright, the foundation beneath them is fragile. And just a few states away lies a place where the lights were never bright to begin with. Number 9. Mississippi. Mississippi has always been one of America's poorest states, and that's what makes it so vulnerable now. When recessions hit, Mississippi doesn't just slow down, it grinds to a halt. The state ranks among the weakest in every measure of economic stability. It has the smallest budget reserves, little revenue diversity, and one of the weakest unemployment insurance systems in the nation, according to the Center on Budget and Policy Priorities. In simple terms, Mississippi doesn't have much saved, doesn't have many different industries, and doesn't have enough help for people who lose their jobs. As of 2024, the unemployment rate hovered around 5.7%, and nearly 1 in 5 residents lived below the poverty line. Many rural towns depend on low-paying jobs in farming, retail, or small factories that barely keep people afloat. Private investment is rare, meaning there aren't enough new businesses or job opportunities. Education funding is low, which keeps skilled workers from staying or moving in. It's a cycle that repeats generation after generation. When the economy slows nationwide, Mississippi feels it faster and longer than almost anywhere else. Job cuts in manufacturing ripple through the small towns. Families fall behind on bills. Hospitals, already short on funding, face staff cuts. Teachers leave for higher pay in neighboring states. There's no real cushion, no strong middle class, no booming tech sector, no emergency reserves big enough to keep things stable. Mississippi's collapse might not shake Wall Street, but it would be devastating for the people living there. And it would drag down the entire Deep South region with it. Number 8. Louisiana. Louisiana is a warning sign for what happens when a state never truly recovers between crises. It's been on a financial tightrope for years. The state's economy leans hard on oil, gas, and tourism, 3 sectors that rise and fall like tides. When oil prices crash, drilling slows down, workers lose jobs, and the tax money that funds schools and hospitals dries up. When hurricanes hit, billions must be poured into recovery. And when tourists stay home because of storm damage or inflation, the whole system takes another hit. In 2020 and 2021, hurricanes like Laura, Delta, and Ida wiped out communities and forced over $10 billion in repairs and relief. By mid-2025, unemployment was hovering around 6%, with some coastal parishes pushing past 7%. A report by U.S. funds warned that Louisiana could lose nearly 1/5 of its revenue, about 19.9% of its 2019 levels if a severe recession takes hold. For a state already struggling to keep basic services running, that kind of hit would be devastating. The real pain wouldn't show up in stock charts, it would show up in families. Oil rig workers laid off in Lafayette, hotel staff in New Orleans waiting for tourists who never come back, and shrimp boat owners watching diesel costs skyrocket while their catches sell for less. Each downturn leaves deeper scars, and every recovery feels shorter than the last. Number 7. South Carolina. At first glance, South Carolina looks like one of the South's success stories. New factories, a population boom, and rising business investment have given the state an image of growth. BMW and Boeing plants have brought jobs, and new residents from the north keep moving in. But growth has a dark side. Between 2023 and 2025, housing costs in some counties jumped as much as 10%, while wages barely kept up. Families are spending more just to stay in place. The state's economy depends heavily on exports, making it vulnerable when global demand slows. If trade slows or inflation eats into consumer spending, orders will drop. Smaller factories around Greenville or Charleston could go silent fast. Meanwhile, state reserves aren't deep enough to cushion a hard landing, leaving South Carolina exposed when the next economic wave hits. Debt levels are climbing, especially among younger workers who borrowed for homes and cars during the boom years. When jobs dry up, those loans become anchors. Local governments already rely on property taxes from rapidly inflated housing markets. If those values fall, city budgets will crack. South Carolina might not be the first to collapse, but when it does, it'll reveal how fragile the Sun Belt's growth story really is. And right next door, one of its biggest neighbors faces the same danger, just on a much larger scale. Number 6, Georgia. Georgia is a powerhouse that looks untouchable on the surface. Atlanta is booming, Savannah's port is one of the fastest growing in the country, and big companies are setting up headquarters across the state. But that success hides a dangerous imbalance. Metro Atlanta's housing prices have exploded, up over 25% since 2021 in some areas, while wages haven't followed. Many newcomers are stretched thin with mortgages, car payments, and student loans. Georgia's economy depends heavily on trade and logistics. When global supply chains slow down or tariffs rise, Savannah's port traffic falls and tens of thousands of related jobs, from truckers to warehouse workers, are at risk. Infrastructure spending across the state is also straining local budgets. Counties are borrowing heavily to keep up with rapid growth. And while Georgia has built up decent reserves in the past, reports from late 2025 suggest those cushions are shrinking fast as spending outpaces revenue. If a national recession deepens, Georgia could see mass layoffs ripple through its logistics, housing, and retail sectors. The domino effect would reach neighboring states quickly, especially those tied to its ports and supply chains. The fall of Georgia would be a wake-up call that even the fastest-growing states can crack under pressure. And as we move north, we reach a place that's been carrying heavy baggage for years. Number 5, Illinois. Illinois doesn't need a recession to feel like it's collapsing. It's been on the edge for decades. Between 2015 and 2017, the state went 793 days without a full budget. That chaos forced schools to delay payments, public universities to cut programs, and social services to shut down. By the time lawmakers reached a deal, the damage was deep. Billions in unpaid bills, downgraded credit ratings, and growing pension debt that now tops $140 billion. Even in good years, Illinois has struggled to pay for basic operations. According to Pew Charitable Trust, the state's reserves can only cover about 15 days of spending. Less than any other large state in the country, property taxes are among the highest in the U.S. Yet public schools in many districts are still short on funds. As a result, families and businesses have been quietly leaving for years, especially from the suburbs around Chicago, where rising taxes and falling home values hit hardest. In a recession, Illinois would have nowhere to hide. With such limited reserves, it would likely face cuts to essential services and higher borrowing costs almost immediately. Pension funds would strain even further, and local governments would face insolvency. When Illinois cracks, the shockwaves wouldn't stay within its borders. The state's financial markets and bonds are tied to pension systems nationwide. Its collapse would send a message across the country that when you ignore fiscal wounds long enough, they eventually burst open. Number 4, Michigan. Michigan tells a story of two realities, one shiny, one crumbling. Detroit's skyline might be filling again, but outside the spotlight, things aren't adding up. Manufacturing has long been the state's backbone, and when that backbone weakens, everything else shakes. In 2024, Michigan lost about 9,000 manufacturing jobs, roughly 1.2% of its total base. 14 major plant closures were announced in just 1 year, with auto parts suppliers in places like Lansing, Saginaw, and Flint among the hardest hit. For a state that depends so heavily on cars, this is a warning sign. Michigan's economy still rides on the global auto market. When people buy fewer vehicles or when supply chains falter, factories slow down, that hits the state's tax revenue fast. According to Pew Charitable Trust, Michigan's financial reserves have dropped dramatically, down by the equivalent of 189 days of spending. That's a staggering fall in the cushion that keeps public services afloat during hard times. Cities like Flint and Kalamazoo, already struggling with weak tax bases and aging infrastructure, feel every dollar that disappears. For families, the pain is sharp. There are fewer job openings, higher bills, and little room to breathe. Many residents are still paying the price for decades of decline. Public pensions are under strain, and roads and water systems need billions in repairs. Michigan's economy may look steady on paper, but underneath, the structure is fragile. The state's fall would confirm what many already fear, that America's old industrial heartlands never truly recovered. And that realization takes us to a place that has long bragged about its independence and strength. Number 3, Texas. Texas has built its image on confidence. Big oil, big jobs, and booming cities. But even giants can trip. Beneath the bravado, Texas is sitting on a pile of financial stress. A 2025 report on financial distress showed that the state had one of the highest rates of consumer forbearances, people delaying debt payments, and non-business bankruptcies jumped by 22% in just 1 year. That means everyday Texans are struggling to pay bills, even while headlines talk about growth. Local governments are also carrying massive infrastructure debts. Rapid expansion in cities like Austin, Dallas, and Houston has come with a price. More roads, more schools, more utilities, all built on borrowed money. The state's population growth has been driven by migration, but many of those new arrivals bring high debt and limited savings. When the economy slows, they'll be the first to feel it. Then there's energy. Texas depends heavily on oil and gas, and when prices fall, jobs vanish overnight. The 2014 crash still haunts smaller oil towns, and the next one could be worse. Housing markets are another pressure point. Prices have climbed fast, but demand is cooling. If layoffs rise and home values dip, Texas could face a housing correction that would ripple through its banks and tax system. Given Texas's size, any collapse here would be impossible to contain. The country's largest energy hub, one of its biggest housing markets, and several key ports would all be hit at once. The Texas economy has carried the image of American resilience, but that image could shatter quickly in a recession. And from there, the focus shifts to a state so large and influential that if it buckles, it could drag down half the nation's economy with it. Number 2, California. California has always been seen as the land of opportunity, but that dream is fading fast. The state produces enormous wealth, accounting for about 15% of the entire U.S. economy, but it also carries enormous risk. Its biggest strengths, tech, entertainment, and real estate, are all tied to market confidence and high incomes. When those soften, California shakes. By late 2025, unemployment had climbed to around 5.5%, the highest in 3 years. Housing markets that once seemed unstoppable are starting to flatten. In parts of the Bay Area, home prices have dropped by nearly 6% since 2024. Los Angeles saw rent growth stall after years of double-digit increases. California's tax system depends heavily on the wealthy, especially from capital gains. When stocks and tech valuations drop, so do state revenues. In fact, according to Pew Charitable Trust, the state's reserves have already fallen by around 34% in just 1 year. That's a serious problem when you're managing a $300 billion budget. The tech slowdown, entertainment strikes, and a cooling property market have all chipped away at confidence. Homelessness continues to climb, over 180,000 people without stable housing, and local governments are stretched thin trying to manage rising costs. If California weakens further, the impact spreads everywhere. Silicon Valley funds thousands of startups nationwide. Los Angeles drives global media, and its ports handle a massive share of U.S. imports. When California stumbles, it pulls the country down with it. But there's one state that could hit even harder. Number 1, New York. New York is the core of America's financial system. What happens here echoes through every bank, business, and government office across the country. But beneath the surface, the state is straining. In mid-2025, Manhattan's office vacancy rate climbed past 15%, the highest since the pandemic. Remote work has gutted commercial real estate. and entire skyscrapers now sit half empty. That's billions in lost property taxes for the city. Meanwhile, the state's revenues are slipping. Budget forecasts show multi-billion-dollar shortfalls for fiscal year 2026, and watchdogs are warning that both state and city budgets are unaffordable and unprepared. Pension obligations are massive. The cost of living remains among the highest in the world, and thousands of residents are leaving each year for cheaper states. The once unstoppable housing market in New York City is cooling fast, rents have stopped rising, and luxury properties sit unsold for months. Consumer spending is slowing, and small businesses are closing faster than they're opening. The financial industry, which provides nearly 20% of state tax revenue, is tightening belts amid market volatility. A downturn on Wall Street instantly drains state funds, cuts city services, and triggers layoffs. So, if New York collapses, the dominoes won't just fall, they'll explode. The entire U.S. economy depends on New York's stability. And as the country moves deeper into recession, the state that once defined American ambition could end up defining its downfall.